Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, January 9th, and then we'll see how things look for Wednesday, January 10th. We ended up having a down day. Things were more negative in Tuesday's session than what we saw in Monday's session. We're still seeing some weakness in the intermediate term that continues to develop. However, in the short term, we're still above the 20-period moving averages. Now, we have some big economic reports coming out later in the week. The biggest one will be CPI on Thursday. We'll have to see if the market ends up quieting down a little bit ahead of that session and chops more or less sideways. And then as we try to play out each day, maybe things will get a little bit more clear. Or are we going to end up with another day like last Friday where we had a strong report and a weak report on the same day? They're both influential, and the market really didn't know what to do. All right, let's go back and talk about what happened. Right at the open, we did have a gap lower open. The futures were weak as Europe was experiencing some weakness. And the idea was, okay, are we going to gap lower and that's going to lead to a lot of selling, or are we going to gap lower and that may be seen as a buying opportunity? And for the most part, we were able to bounce up off of that gap lower open. We were below the daily pivot at 47.43, and then we rebounded back above the daily pivot. Then we rose to the unchanged level, and that's that built-in resistance level on a down day. It's a built-in support level on an up day. But then we fell back around this 47.50 level, which seems to be kind of important. It's a round number. There's probably a lot of strike prices there. You have a lot of options that are either going in or out of the money as we go above or below that level. And then we closed slightly lower on the day. We were down 0.15% on below average volume still. And we'll go through and talk about the technicals, but in the short term, we are showing some improvement as long as we're above the 20-period moving averages. Intermediate term, we're showing some weakness, and we're still overbought in the long term. And the market is really anticipating the inflation report that will be coming out, and we also want to keep an eye on the geopolitical concerns. Some comments is that mega caps did outperform in spite of some tech earnings warnings that came out. Companies like Nvidia, I think Apple did okay. Some of the other companies, they ended up being positive, but then there were some warnings that came out that drove prices more negative. And however, by the time we got done with the day's session, the mega caps did end up doing better than the rest of the market. Our intermediate term list, we still have a relatively long list that's not changing all that much. We have our 50-period exponential moving average, the rate of change going back 50 periods. Our oscillators are all below their moving averages and rolling over, but some of them are still extreme positive. We have a couple of good up days. Those could end up turning and going back up. Our bullish percent index for the NASDAQ 100 as well as the S&P, and then our new high, new low study based on 10 periods for the S&P. Long term, we're still above the 150 simple moving average, and we're above the 200-period exponential and simple moving averages. The scenario that we've been dealing with now is that, okay, maybe the Fed's done raising rates, or they're possibly going to cut rates. It's not as strong of a conviction as we were seeing a few days ago that they may start in March. We'll have to see how the economic reports play out from here. But last week when the Fed met, they also interjected this idea that, okay, if we start seeing stronger than expected economic reports, we may have to jump back in and raise rates. The dollar was up and interest rates were also up, and both of these gave some pressure to stocks. We closed at 4.02% for the 10-year yield. That's right on that level that RenMac has come up with, saying that when we go above that, that starts biting into corporate profits. When we're below that, it doesn't have as much of a negative impact. The 10 to the 2 and the 10 to the 3 month, these for, my goodness, year and a half, some of them almost 2 years now, have remained inverted. Sentiment did tick down. It's at 73, but that's still positive, but it did come in one number lower at 73 where it had been at 74. Our trend is still positive. The green line's on top, but it is a weakening trend, both for the intermediate term and the short-term chart. We're below 40 now on both of those, so they're not on our extreme list here, but we are seeing that the ADX is coming down. That doesn't necessarily mean that we're going to see a change in trend. It just means it's a weakening trend. Our bias, I changed over to mix. We had the solid update on Monday, and then it was really more negative than positive on Tuesday. And our momentum is more mixed right now, too. So the market's a little bit muddy. Then the economic reports that came out, we didn't really get all that much. We had the trade balance came in at a minus 63.2 billion. That's a little bit lower than the minus 64.7 billion they had expected. Last time it came in at a minus 64.5 billion. I don't have any charts to show today because what we did have come out is not a real market mover. I do have a few Isabel Net blog charts to show you, and these are the 2024 earnings per share revisions, and they're actually starting to do better, at least as we start 2024, than they did in 2023. Up here on the left, the dark blue line, this is what's happening as far as the revisions. Now they're coming down, and that's not positive, but they had expected them to come down even more, so they're above what the expectations are. Then we have cyclicals. Cyclicals, just like the name says, when the economy's doing well, cyclicals do well. When the economy's not doing very well, we get into defensives. These are companies that produce things that you have to have, even if the economy's running into difficulties. Or cyclicals, you can be a little bit more choosy. And this is really continuing to come down, meaning that defensives, as we started to get into the latter part of 2023, they were starting to underperform. Or you could say that another way, saying that the defensives were starting to outperform after we had been seeing a pretty nice run up, which helped give some support to stocks. But this was going up as we were going down with stocks. So I wouldn't necessarily base decisions on this chart. It's just something that we want to be aware of. Looking at our intraday chart where we did gap lower below the daily pivot, we were able to come back up to the daily pivot. We climbed up to the unchanged level. We spent a very brief period of time actually being positive, but that wasn't really happening. We stayed below the unchanged level, drifted back down, and then saw a little bit of buying going into the close to not have us be down as much. Here's the intraday chart where we were a lot more negative in the pre-market session. That showed some improvement after the cash session opened up, and we're pretty much flat right now in the initial overnight session. We're still seeing a little bit of an improvement with growth versus value, but overall it's underperforming. The blue line is underperforming the red line. Now these are on different scales, so you're going to get some kind of optical illusions here for this, but we look more positive when we see the blue line above the red line. Here's the intraday chart for the S&P. This is showing some improvement. This is a little bit encouraging. We saw a nice little spike up in Monday's session, and even though Tuesday ended up being more negative, we are showing some intraday improvement anyway with this ratio. End of day, growth was up where value was down for the large caps. It ended up being down, but down less for the mid caps and was also down less for the small caps. And we are bouncing back up. Now we have some damage to repair here. We were in a sideways trend for a while. It was a longer term uptrend, but we got down to the lower end of this range, broke down below it, and now we are starting to come back up. But we need to see a lot of follow through for this to turn back more positive. Keeping an eye on our trend where the ADX, this is the intermediate term chart. We're now dropping back below 40. We're currently at 39, but we're below the moving average. However, we do default to positive. Even though the green line declined, it is above the red line. Short term, we're also dropping below the 40 level. The green line is also on top, even though it declined. But both of these are suggesting that it's a weakening trend. We're just not really performing all that well right now when it comes to volume. We're still well below the midpoint. Keeping an eye on sentiment, the Ulcer Index was pretty much flat with the slight down day that we ended up having. And we actually came down with the VIX on the line chart as well as the bar chart. We're just not seeing an awful lot of fear. We're getting very low readings for the VIX, suggesting that the market is kind of in that complacency area. Here's the VIX of the VIX, which also declined, both with the bar chart as well as the line chart, showing not a lot of fear. We're keeping an eye on this. We actually came down a little bit with our VIX to S&P 500 correlation. After Monday's session, we spiked above this dashed line, and anytime we get above that, that tends to be a stronger signal. We actually had a signal generated last week. It came up and then started to come back down. We were wondering, okay, is that enough of a signal? Did we get high enough with this rate, with this correlation? Well, then we ended up going back up after Monday. Now we're starting to come back down. This is typically negative short to intermediate term for the market. Equity put call ratio ticked back up a little bit since we had the slight down day, but our 5-period continues to decline. So that's short to intermediate term positive. We look at the risk on to risk off ratio. We've seen 2 up days now. That's rather encouraging, but we need to see more. We had been showing a lot of improvement. Then we fell back as the market was declining to start the year. Now we've had a couple of up days. Our advanced decline line studies, we ticked down just a little bit based on price and volume. We're still above the moving averages with both. So this so far is hanging in there, and we're continuing to see a drop off in the new highs. That's the negative part. The positive part is we're not seeing any kind of an expansion of new lows. That's causing our 5-period to flatline, but we're still declining with our 10-period moving average. We ticked down a little bit with the advanced decline ratio, but we're still above 0. So this is positive. Accumulation distribution is still above the advancing moving average. That's positive. The chicken money flow declined a little bit. If we can get back up and see the red line turn back up, that would be more positive. And looking at our cumulative advanced decline line, we did have a down day for the broader market. So we saw this going down. We ticked down just slightly with our regular NYSE advanced decline line. Looking at our advanced decline line studies, where we were down for the NYSE common stock, the S&P, the mid caps, and the small caps were down, but you can see how they're going down a lot more. So there's still some weakness inside the small caps. Our short-term chart, we really didn't change all that much. On a positive note, we are still above this pivot point. We haven't really fallen down below that, at least yet. But we haven't really broken out to the upside either. We're just kind of chopping sideways right now. On the bottom, we have volume continuing to be below average. Here is the decision point chart, just showing the trend models are all positive, where with the PMO signals, we're negative. And this is the indicator that I show, this very first area. We're actually negative because we drop below the moving average. We're positive in the intermediate term and negative in the long term. Our moving average study, we ticked down a little bit with the 20, 50, but we're still extreme. We actually went up just a little bit with our 200-period moving average study. And this is what we're watching for right now, the 20-period moving averages, either the simple or the exponential moving average. We're still maintaining price above both of these moving averages. That's the short-term line in the sand. The force index was down a little bit, but it's still above 0. But on the other side of this, we're still below a declining midpoint. The stochastics in the short term, not really giving us any kind of an extreme reading right now, seeing a little bit of an improvement with the intermediate term, and we're no longer extreme positive in the long term. We're still up in the +2 channel for our standard deviations chart. And we're coming back up to the 20-period double and triple exponential moving averages. It'd be nice if we could break above that. The lines are turning up just a little bit, but we want to see this really turn and go back up if we're going to stay more positive. If we roll over and start to fall down, of course, that would look more negative. Intermediate term, the balance of power ticked down just a little bit, but we're still above the 0 point here, so it's still positive. We continue to be positive with the go, no-go system with the darker blue bars. We're above the midpoint with our highest high value. That's still maintaining a positive stance. The TTM squeeze, though, continues to decline. It's positive, but we have the darker blue bars that continue to decline. In our 50-period moving average study, based on double and triple exponential moving averages, we're above the double, but we're still below the triple. The ease of movement was pretty much flat in Tuesday's session. It had gone negative after Friday. It went back positive after Monday. Really didn't decide anything on Tuesday. We're starting to show a bit of a decline here with the Arun as the buyers are starting to trail off and the sellers are picking up here, but we're still positive since the oscillator itself is above 0. We're still below 0 with the S&P McClellan oscillator. We showed some improvement and actually turned back more positive. After Tuesday's session, we came back down. So when we look at the summation index based on price, we're back to declining now. We have been declining based on volume. When we look at the NYSE McClellan oscillator, this is a broader measure. We continue to be below zero and we declined. So we're turning down based on price and volume with the NYSE summation index. We're turning down just a little bit based on price with the Swenlin trading oscillator, and we're still below zero. We're pretty much flat based on volume and also still below zero. That's more negative. And these are our oscillators. The PMO is below its moving average, still giving us an extreme reading, but it is declining. We're also declining based on price and volume. We're still seeing this longer-term negative divergence with the percent of PMOs that are rising. As the market was going up, these were going down. That's a negative divergence. Also, the buy signals were going down as the S&P was going up. We're still extreme positive with the PMOs that are above zero. We remain positive with the Elder's Impulse system for the S&P. We still remain negative with the Parabolic SAR system. And we're rolling over and no longer extreme with the slope. We're below the moving average and now declining. The MACD is also below its moving average. We look at all of our oscillators. We're declining pretty much across the board. And not really extreme positive here, but we're working off some of this. So if the market does turn back more positive, we'll at least have a little bit of time before we get extreme positive again. Of course, if we turn more negative, these are going to continue to decline. We're still playing around with the 20-period moving averages here on our moving average tree. The bullish percent index continues to decline, but it's still above 70. The NYSE bullish percent index declined slightly, never did get up to 70, but it's still positive since it's above 50. The NASDAQ 100 bullish percent index was pretty much flat. It was giving us a really extreme positive reading. It's coming down and has yet to drop below 70. The Sean trend meter, pretty much flat, still looking fairly positive. The Chaikin oscillator is now crossing back above the midpoint, so that's turning a little bit more positive. The percent B indicator, we're still above the midpoint as we're coming a little bit above the midpoint on the Bollinger Bands chart. And that tends to give us more of a positive stance when we stay above that middle area. The money flow index continues to be above 50. That's turning more positive. The ultimate oscillator also above 50. That's more positive. The vortex still has the green line on top. That's positive. The rate of change just still is continuing to give us a very, very high reading. The RSI 14 still above 50, even though it declined. That's positive in the intermediate term. We declined in the short term, but we're also still above 50. That's more positive for the short term. On balance volume did decline just a little bit, but we're still above an advancing moving average. Here's our NYSE advanced decline line where we're seeing our recent golden cross here, even though we had a down day. And then the NYSE new highs minus the new lows. The longer we can stay above zero, the better this is going to look. We spent most of 2022 under zero. We peaked up a couple of times in 2023. We want to know, does this have some staying power? That's going to turn things back more positive. If we drop back below the 0 point, that'll turn things more negative. And then looking at our 200-period moving average study, we turned down just a little bit, but we're really close to this extreme reading. We turned down with our 50-period moving average, and we're still at a very, very extreme reading. Keeping an eye on the 50-day cycle, I'll probably stop showing this after this week, where we did start a new cycle on January 2nd. That was down. Now we're starting to see a little bit more of a bounce. And I always find this interesting. I created this indicator decades ago for a trading system, and I stopped doing the trading system, but I kept the indicator, and I'm just kind of amazed that this can actually be helpful as its own individual chart. Where we came back down into the mini rainbow. This is kind of like studying the 20-period moving averages, but we're doing the open, high, low, close. So as long as we can stay above this, we're still looking more positive in the short term. Our different charts, we're looking a little bit better with the Heiken Ashi. We're still negative with the Kegi. That's because it's red, but it is pointing up. And we're looking more negative with the Renko, and we're also looking more negative with the 3-line break. So we're seeing some mixed signals here. We're still extreme positive with our 150 and 200-period moving averages here. We're still above the trend line when we look at the long-term chart. We're right on the trend line with the NASDAQ 100 long-term chart. And the S&P outperformed the equal weight index in Tuesday's session, but we are seeing some gradual improvement with the equal weight index. but we ended up going up with this ratio. That means the mega caps outperformed the broader market. This is another concern, though, with the Dow. We were down with the Dow. We were down with the transports. We're still seeing a longer-term negative divergence. The Dow was going back and setting all-time highs. The transports were not even able to get back to this previous high, and we ticked down just a little bit with the utilities. And the transports continue to underperform the Dow. That is a concern. The Dow is hanging in there. It was down 0.42%, but now it's starting to more or less chop sideways. We switched back over to neutral for the Elders impulse system with the diamonds. The NASDAQ is still hanging in there. It was up just barely, but it's still above this pivot point. And the NASDAQ 100 also saw a little bit of an advance above the pivot point. So that's hanging in there for right now. We remain positive with the QQQs when looking at the Elders impulse system. However, on a momentum basis for the NASDAQ 100, we're still negative, even though we're turning up with the PPO. The small caps, they ended up dropping down again. We had recaptured this pivot point. Now we have dropped down below that. The small caps have gone from being positive over to negative with the Elders impulse system. And we're back a little bit further below this either support or resistance level. I guess it would be resistance now, where we're just a little bit below 50 with the RSI. This is when we look at the Russell 2000 small cap index. We did generate a recent golden cross. That's positive, but on a shorter term momentum basis, we are negative. The mid caps are still above the pivot point. They didn't really see much of a decline in Tuesday's session. However, they have switched over to negative after being positive with the Elders impulse system. The FANG index was up a little over 0.25%. That's still hanging in there. And the dollar ended up being up. That was putting some pressure on stocks. Keeping an eye on the 10-year yield. We were up with the 10-year yield from Monday to Tuesday. That also pressured stocks. So we were down slightly based on price. And then updating our growth to value ratios, we're seeing a little bit of an improvement here with the Qs to S&P, but we're still under a declining moving average. We're not really seeing much improvement with discretionary to the S&P. We did see an improvement with large cap growth to large cap value, but the moving average continues to decline. Our other growth to value ratios, seeing a little bit of an improvement here with the large caps, mid caps, and we ticked up with the small caps, but we're further away from the moving average. We're still pegged near the top with our 10-day average of the S&P 500 highs minus the lows. We're hanging on by a thread here, but we continue to be positive when we look at the broad market and take a 5-period moving average of the highs minus the lows. This is still coming down with our 50-period new highs, new lows study for the S&P, but we're well above zero. So we're positive, but pulling back. The 2-year Treasury yield has been coming down lately, and that could be giving some support to the S&P. So what's our outlook for Wednesday? Is the January effect over? We don't really know yet. We need to see some back-to-back updates. We need to see follow-through. And also, we're 0 for 2 right now with our trifecta score. We'll get the third answer at the end of January. The technicals are positive, but weakness continues to develop. And that's more intermediate term, where we're still above the 20-period moving average. That's more short term. We'll get the MBA mortgage applications index as well as wholesale inventories. And then, like I always say, we need to keep an eye on what's happening in this crazy world. CPI will be coming out on Thursday. That'll probably be the biggest report of the week. And then we're going to get PPI on Friday. Seasonally, we do look pretty positive here for January 10th. We're neutral to positive with the Dow, where we're positive with the S&P and NASDAQ. And then here's another chart from Isabel Net blog charts where it says, okay, what happens when we get a negative Santa Claus rally, which is what happened? And then what happens after the first 5 trading days are negative? Well, looking at their research here from 1956 up to this year, for the month of January, we don't know if we're going to be down yet or not, but the average over this time is we're down 1.7%, with the median being 2.5%. We're positive 27.3% of the time. Okay, that's not looking very good. When you go through the first quarter, so from now until the end of March, we do see positive returns and a better positive rate. If you go out a year from now, where we also see even better returns and an even better positive rate. So just the idea that we started off with 0.2 for our trifecta doesn't necessarily mean everything's going to fall apart in the longer term. Then we will be on the 7th trading day of the month, where when we look at an election year, we do see a little bit of weakness with the green dash line. We're wondering where we're at in this whole January effect. It's really kind of on hold for right now. And then looking at the election year seasonality, where we are pretty choppy, as this is kind of how things are playing out right now. And we're also pretty much sideways with the Stock Traders Almanac during the beginning of an election year. But when we have the sitting president running for re-election, and again, we're not really sure if that's how it's going to play out. But when that happens, we should be seeing more strength than what we've been seeing now. So this is underperforming seasonally so far in 2024. We will be on Wednesday's trading session. That tends to be the most negative day of the week, even though we have positive seasonality. So our scenarios, really hard to go with the down one, even though we are seeing weakness developing. We still have a lot of positive things in the background that could still recover, but we need to see follow through price action. And we're keeping an eye on the 20-period moving averages. That is helping maintain our positive stance. And we're no longer extreme with our ADX, either in the short term or intermediate term. So I've changed that from being red back over to white. We still default to positive because the green line's on top. However, it is a weakening trend. So the warning signs, we're still concerned about this growth versus value ratio. It's showing weakness. We've seen it bounce up over the last couple of days, but we need to see more follow through. The risk on posture has been coming down, but we've seen a couple of positive days for that. We need to see more follow through. This is going to take quite a while to work out. The transports continue to negatively diverge against the Dow. The 1 to 3 month short-term bond spread, it continues to be positive. I haven't been showing that chart. The parabolic SAR continues to be negative, as is the Kopic curve. Our oscillators, they're extreme and they're rolling over and they're all dropping below their moving averages. Now, hopefully, if you're more positive on the market, we're working off these extreme readings before we can turn and go back up. Or if we start to see more selling, this could develop into a more negative situation. The NASDAQ 100 PPO continues to be negative. The positive signs, our daily special K chart is still positive. We're still headed down with our 5-period equity put call ratio, as well as our 253 period for the equity put call ratio. The bullish percent index is still extreme, coming down, but hasn't dropped below 70. The vortex, we saw that after Monday session, it crossed back over positive. It continues to be positive. The Zohorchak method has not changed. This is positive because it had been negative and we've actually improved to neutral. The Russell, the small caps and the mid caps are working off of positive trends that were generated recently. Small and mid cap growth continues to be positive, but we're chopping sideways. The financial sector still hanging in there fairly well. And our new high, new low study for the S&P is still positive. So our conclusion, we are positive, but there is weakness. We need to see some buying on an increase in volume. But for right now, the 20-period moving averages are holding up. That's what we can say for the short term. Intermediate term, we're still dealing with an overbought situation. We are seeing some weakness starting to develop. We still have some overbought conditions in the long term, but we're still positive because we're above the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.